In both the US and Europe, headline inflation, which includes volatile fuel and food prices, continues its descent. However, core inflation, excluding these variables, remains stubbornly high at 4.3% in the US and 4.5% in Europe, indicating that central banks' efforts to reach their 2% targets are ongoing. Consequently, the expectation is that interest rates will remain elevated for an extended period, with the possibility of further increases. This scenario raises concerns for bond investors about the potential impact on their portfolios. Rising interest rates can pose a short-term threat to fixed-income investments, particularly for longer-dated bonds, which are more sensitive to interest rate fluctuations. In this uncertain landscape, effectively managing duration, a crucial measure of a bond's sensitivity to interest rates, becomes paramount. Shorter duration strategies, involving investments in bonds with shorter maturities, offer a potential solution to mitigate volatility and reduce interest rate risk in fixed-income portfolios. Moreover, in the current market conditions, these strategies provide the added benefit of potentially attractive yields. Seeking attractive yields in a volatile market with short duration. Stability and income are primary considerations for investors holding government bonds for diversification, and currently, U.S. Treasuries and European government bonds present promising opportunities for steady yields after an extended period of low interest rates. Specifically, short-dated Treasuries in the U.S. and short-dated government bonds in Europe offer enticing coupon levels with minimal volatility risk. For instance, 2-year government bond yields hover around 3.2% in Europe, German Bund, and 5% in the U.S., Treasuries, the highest in over a decade. In the credit landscape, higher-quality investment-grade debt is also appealing, providing the potential for stable cash flows. Particularly noteworthy are European shorter-duration investment-grade bonds. Given the European Central Bank's commitment to combating inflation and the uncertainty surrounding future interest rate trajectories, these bonds are less exposed to interest rate risk compared to their longer maturity counterparts. Looking forward, the transition to higher funding costs is anticipated to be quicker and more challenging for high-yield-rated corporates, which have limited cash flow generation and higher short-term refinancing needs. The current tight valuations of high-yield assets are not aligned with expectations of lower growth in the foreseeable future. In this uncertain environment where interest rates are poised to remain elevated for an extended period, managing duration is crucial for risk reduction and potential performance gains. Shorter duration strategies not only shield portfolios against rising rates but also present attractive income opportunities. For ETF investors, the implications suggest a need for strategic adjustments to their fixed income allocations. Here are some key takeaways. Preference for short-duration ETFs. Given the potential for prolonged higher interest rates, ETF investors may consider favoring short-duration bond ETFs. These funds typically invest in bonds with shorter maturities, helping to reduce sensitivity to interest rate changes and mitigate volatility. Diversification in government bond ETFs. Investors may find opportunities in government bond ETFs, especially those focusing on short-dated Treasuries in the US and short-dated government bonds in Europe. These ETFs could offer steady yields with lower volatility risk in the current market conditions. Focus on investment-grade debt ETFs. ETFs that track higher-quality investment-grade debt, particularly shorter-duration investment-grade bonds in Europe, may be appealing. These assets are viewed as less exposed to interest rate risk compared to longer maturity counterparts, offering stability and potential for stable cash flows. Caution with high-yield bond ETFs. A cautious approach to high-yield bonds, as the transition to higher funding costs is expected to be faster and more challenging for high-yield-rated corporates. ETF investors may want to reassess their exposure to high-yield bond ETFs, considering the tight valuations and the potential for lower growth. Monitoring interest rate risk. In an environment where rates are likely to stay higher for an extended period, ETF investors should closely monitor and manage interest rate risk within their portfolios. This involves understanding the duration of the bonds held by the ETFs and considering adjustments to align with the expectation of elevated interest rates. Seeking attractive yields. ETF investors may find opportunities to generate attractive income by selecting funds with a focus on short-duration strategies, especially those with exposure to regions and sectors offering higher yields while managing risk effectively. In summary, ETF investors should be proactive in adjusting their fixed income allocations to navigate the challenges posed by prolonged higher interest rates. Emphasizing shorter duration, government bonds, and investment-grade debt in their ETF selections may be a prudent strategy to manage risks and potentially capitalize on income opportunities in the current market environment.